Understanding kicker patterns, a comprehensive guide. A kicker pattern is a significant two-bar candlestick pattern in technical analysis, widely used by traders to anticipate shifts in the direction of an asset's price trend. This pattern not only highlights a dramatic reversal in price but also provides insight into the market participant sentiment toward a security. This article delves deeper into kicker patterns, exploring their intricacies, implications, and the context in which they typically occur. What is a kicker pattern? The kicker pattern can be succinctly defined as a two-candlestick setup that signals a potential change in market direction. Characterized by a marked price reversal over the span of two candlesticks, this pattern serves as a critical tool for identifying the prevailing bullish or bearish sentiments within the market. Key characteristics. Two candlesticks. The pattern consists of two adjacent candlesticks where the second candle opens at or near the same price as the first but moves decisively in the opposite direction. Bullish or bearish. Kicker patterns can either indicate a bullish or bearish sentiment. Bullish kicker starts with a bearish candle, followed by a bullish gap up. Bearish kicker initiates with a bullish candle, then followed by a bearish gap down. Market psychology. Kicker patterns are particularly valuable as they highlight a psychological shift among investors. They typically appear following the release of significant information related to a company, industry, or broader economic factors, prompting a dramatic reevaluation of the security's value. The mechanics of kicker patterns. Historical context of candlestick charting. Candlestick charting has its origins in Japan dating back to the 1700s, originally employed for tracking rice prices. Today, this technique is versatile and applicable to a variety of financial assets, including stocks, futures, and foreign exchange. Formation of kicker patterns. To fully grasp how kicker patterns function, it is essential to analyze the context in which they arise. 1. Trend confirmation. The first candlestick confirms the prevailing trend, either bullish or bearish. 2. Reversal indication. The second candlestick opens at or near the close of the first but moves sharply in the opposite direction, signifying a potential reversal in trend. Importance of the kicker pattern. Traders and analysts regard the kicker pattern as one of the most reliable reversal signals available. Its strength is particularly magnified and it occurs in overbought or oversold market conditions. At such points, the psychology around the asset is at a boiling point. The printed candlesticks dramatically illustrate that sentiment shift. Examples of kicker patterns. Bullish kicker example. Day 1, a bearish candlestick indicating a decline in prices. Day 2, a bullish candlestick that opens at or near the previous day's close but proceeds to rise sharply, signaling a reversal in sentiment towards positivity. Bearish kicker example. Day 1, a bullish candlestick confirming an uptrend. Day 2, a bearish candlestick opens at or lower than day 1 and drops significantly, indicating a reversal to a bearish trend. The reliability of a kicker pattern increases when formed in specific contexts such as overbought or oversold conditions. A bearish kicker forming during an uptrend, overbought, could signal a trend reversal, vice versa for a bullish kicker in downtrending conditions. Limitations and considerations. While the kicker pattern is a powerful indicator, traders must remain cautious of its rarity. Most professional traders do not react instantaneously to market movements, hence, kicker patterns are not exceedingly common. When they do appear, however, they can signal substantial shifts in trend and investor sentiment. Additionally, it's crucial for traders to combine kicker patterns with other technical indicators or market fundamentals to build a more robust trading strategy. This approach helps mitigate the risks associated with false signals or market anomalies. Conclusion. Kicker patterns are indispensable tools in a trader's arsenal, offering insights into market reversals through the lens of candlestick chart analysis. By recognizing the formation of these patterns and understanding their implications in the context of broader market dynamics, investors can make well-informed decisions and potentially enhance their trading success. Incorporating knowledge of kicker patterns into your market analysis may provide an edge in navigating the complexities of financial markets, transforming raw price data into actionable insights.